Hey everyone, welcome back to Corporate Decoder. Today, CNL Strategic Capital, L.L.C. just filed an 8K and I'm looking at how they are setting future prices for their investment shares, and it hints at some interesting moves. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is adjusting how much their shares will cost moving forward and how they handle investor cash. And it tells us a lot about their growth strategy. Alright, so CNL Strategic Capital, LLC, a company that deals with investments, has put out an 8K report. This is like a public announcement for events happening now. That might be important for investors. The main thing here is about their investment value and how much they're going to charge people to buy into their funds. It all happened on the 24th of July 2026. Let's dive into the numbers. The company's board of directors met and decided on the net asset value, or NAV, for all their different classes of shares. Think of NAV as the real value of each share based on all the company's assets minus its debts. This was decided for the month ending the 30th of June 2026. Looking at the table for the 30th of June 2026, we see different share classes like Class FA, Class A, Class A, Class D, Class I, and Class I, and Class S. For Class A shares, the total net asset value was about $160 million, with each share worth $44.34. Class A shares had a value of around $359 million, with each share at $39.14. Class A shares were the largest chunk, with a total NAV of nearly $700 million, each share valued at $39.5. Across all classes, the total net asset value was a massive $1.48 billion. Now, how did these values change from the previous month? For Class FA, the NAV per S-share went up to $44.34 from $44.1, a small increase of $0.24. Class A shares saw a similar small bump, moving from $39.02 to $39.14, an increase of $0.12 per S-share. Most share classes saw slight increases in their value, per S-share, with Class S showing a $0.2 jump. This general uptrend in value is a good sign, showing that the company's investments are likely doing well. And why did this happen? The report explains that the main reason for these increases in value was that most of the company's investments, 14 out of 18, saw their values go up. This is a really positive indicator that their investment strategy is paying off. They also mentioned that the fair value of 4 investments actually decreased, but the gains from the others more than made up for it. As of the 30th of June 2026, the company had total assets of about $1.56 billion, which is a significant amount. Moving on, let's talk about how much people will pay to buy these shares soon. On the 24th of July 2026, the board okayed new prices for selling these shares. These new prices will kick in on the 31st of July 2026, which is very soon. This is important because it tells us how much the company expects its shares to be worth to new investors. For Class A shares, the new public offering price will be $42.78 per S-share. This is higher than the net asset value of $39.14 we saw earlier. This difference is where the company and its sales team make their money. They are also telling us about selling commissions and dealer manager fees for Class A. There are $2.57 in selling commissions and $1.07 in dealer manager fees. This means that for every share of Class A bought, a good chunk of money goes towards sales costs rather than directly into the company's investments. Class T shares will have a public offering price of $41.01. They have selling commissions of $1.23 and dealer manager fees of $0.72 per S-share. It is interesting to see how these fees vary between share classes. This pricing strategy is how they attract investors and fund their operations. The fact that they are setting new prices suggests they are confident in the value of their offerings and the market's willingness to buy. Now, let's talk about distributions, which is how companies pay out profits to their shareholders. On the 24th of July 2026, the board declared cash distributions for all share classes. The record date for these distributions is the 26th of August 2026, and they will be paid out on the 27th of August 2026. This means if you own shares by the 26th of August, you'll get a payment. For Class VAR, Class R, Class I, and Class S shares, the distribution is $0.104167. Per S-share, Class T shares will receive $0.08333. These are small amounts per S-share, but when you multiply them by the millions of shares outstanding, it adds up. This shows the company is actively returning value to its investors. This next section is really important for understanding how the company has been performing over time. It shows different types of returns for various share classes up to the 30th of June 2026. The year-to-date return for Class A shares, meaning from the 1st of January 2026 to the 30th of June 2026, was 4.5% when you don't consider sales loads. This is a decent return for just 6 months. For Class A shares, the year-to-date return was 4.1% without the sales load. Class S shares did very well year 2. Date, bringing in 4.5% without the load. Looking at a longer period, the 1-year return for Class A shares was 10.8%. Class A shares had a 9.7% return, and Class I shares achieved 9.2%. These numbers show consistent growth over a full year. The cumulative total return shows how much an investment has grown since the share class was first offered. For Class FAR, it is a massive 140% since February 2018. This means if you invested in Class FAR shares back then, your initial investment has more than doubled. Class A shares have a cumulative return of 118.6%, and Class I shares a strong 119.6%. These figures are after assuming all distributions are reinvested, which is a great way to grow your investment over time due to compounding. Now, let's glance at where the money for these distributions comes from for the 6 months ending the 30th of June 2026. About 55.2% came from net investment income. This is the income generated from the company's ongoing operations and investments. Interestingly, 44.8% of the distributions came from what is called distributions in excess of net investment income and net realized gains. This essentially means they are paying out more than they earned from regular income and investment profits. The report clarifies this second category consists of distributions made from offering proceeds. In simpler terms, they are using the money from new investors to pay distributions. This is not always sustainable long term if the company's core investments aren't generating enough cash. Looking at the cash distributions, we see net investment income before expense support was $12,468,000, making up 116% of the cash distributions net of reinvestment. This means their core income before special support covered the distributions, and then some. However, they also had something called expense support reimbursement, which was negative $970,000, or minus 9.0%. This indicates they might have had to pay back some support that was given to them earlier, or that the expenses were higher than expected. The total cash distributions declared after accounting for reinvested distributions were $10,750,000. The footnotes here are important. They mention that expense support wasn't due from the manager and sub-manager for this period, which is good. But the distributions in excess of net investment income and realized gains are funded from offering proceeds, as we discussed, and for the 6 months ending the 30th of June 2026, they excluded over $11 million in distributions that were reinvested back into the plan. This implies a significant amount of cash flow is being managed. Lastly, the report includes a cautionary note about forward-looking statements. This is standard language for companies. They are saying that any predictions or expectations about the future are based on current information and could change. They mention risks like their ability to pay distributions, find good investments, and the general economic conditions, which could all impact their financial results and net asset value. Purse hair. Essentially, they are covering themselves by saying that while they aim for growth and stability, there are many uncertainties that can affect their performance. The report is signed by Chirag J. Bhavsar, the Chief Executive Officer, on the 24th of July 2026. This signing indicates the company is officially making this information public. So, what is the verdict here? CNL Strategic Capital, L.L.C. is setting new, higher prices for its shares, which is a positive sign of confidence. The net asset values are growing and long-term returns are substantial. However, the fact that a significant portion of distributions for the first half of 2026 came from offering proceeds, meaning new investor money, is something to keep an eye on. While they have solid investment income, relying on new cash to pay old investors can be a double-edged sword if investment performance falters. The risk I am watching is their ability to sustain these distributions purely from investment gains moving forward, rather than new inflows. What I am actually looking for is a clear trend of increasing net investment income that consistently covers distributions without needing outside capital. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out our Discord linked below.